Hi, everyone, and welcome to our quarterly market update. I'm Amy Fogle, the CEO of Milestone, and today we have Evan Troop of JPMorgan Securities with us to discuss attorney fee deferral and specifically why today's market is a good entry point to put your dollars to work. Before we get into the market update, I want to talk through what a fee deferral is. Through Milestone's fee master program, your contingency fee income can be spread, grown, and secured over a predetermined period of time. Now, what does that mean? It means we can personalize a periodic payment schedule to receive your funds over time, replacing large tax obligations with flexible, predetermined investments. It's like an unlimited 401k. Now, there's a few steps in the process or points. First, we have to establish a qualified settlement fund or a 468B trust to ensure you don't take receipt of the fees into your operating or IOLTA account. Upon establishing the qualified settlement fund and the associated bank account, we will provide funding instructions and release language to ensure the gross settlement award is directed to your qualified settlement fund account. Again, ensuring you don't take receipt of those funds. Setting up a qualified settlement fund enables you to hold your attorney fees for up to 1 year in the fund. Then you can defer if and when it's desired. When you're ready to defer your fee, the funds are moved out of the qualified settlement fund once your periodic payment schedule has been chosen. And lastly, those deferral funds are then moved and held at a financial institution with a trusted financial advisor to create a customized portfolio to help you ride the waves of the financial markets, which is where Evan comes in. Now, Evan is going to walk us through where the markets are today and his outlook on the fourth quarter and beyond. Evan, this has been quite a challenging year to say the least, and the worst year since the great financial crisis. What has brought us to this point?
Yeah, good afternoon, everyone. So as Amy mentioned, my name is Evan Troop. I'm an executive director with JPMorgan. And my team oversees about $5.5 billion in assets. We also execute on about $1 billion worth of securities every day. But as Amy mentioned, it's been a very difficult year across the board. So if we look at this chart on the investment dashboard, internationally, stocks are down about 25%. Here domestically, they're down about 25 to 30%. And there's really been no safe haven across the sectors. So if you look at the bottom of the page there, all of the sectors have been hit pretty heavy this year, save for energy, which is actually up about 50%. Shifting over to the yields portion of most folks' portfolios on the right side of the chart there, the Barclays US Ag has again just taken it on the teeth as well. It's down about 15%. And so how did we get here? Well, this all came about because the Federal Reserve was very far behind the curve. In 2021, they believed that inflation was going to be transitory. As a result, they kept rates at the zero bound and then also continued quantitative easing, which ultimately made money flowing through the system very easy, and as a result, stimulated the economy to the point that we had rampant inflation. Another thing that's really deterred markets this year is just the overnight increase in geopolitical risk. Outside of the war that's been raging over in Ukraine, we also have new tensions over in Taiwan and other areas within emerging markets that have also been jittering the market. And then the third thing I'd like to mention too is also just the strong US dollar, which has caused a large drag for these multinational corporations who have customers abroad as their purchasing power has gone down. So those three things together have taken us to where we are today, which is a pretty depressed state.
The Fed has been aggressively raising rates, Evan. Do you see this ending at any point this year or into next year?
Yeah, so for this year, we don't see it ending. Our base case scenario is a 75 basis point rate hike for November, followed by another 50 basis point rate hike in December. And then I think at that point, the Fed will probably take pause. Most likely that'll have a very material effect on slowing down the economy. That would put the Fed funds rate anywhere between 4.5% to 4.75%. And so historically, that's done a pretty decent job of providing a headwind to the economy. But I wanted to include this chart here because when you're investing in a bear market, this is a really good framework to abide by. So this was actually created by an economist that's over at Piper Sandler, but I really like the framework. And so basically what he argues is peak to trough, normally that time is plus or minus 24 months, depending on the severity of the bear market. And so early on, if you look at the top left, the first thing that'll go is in housing. And we started to see cracks of that late last year within, it was right around November, December, we had some numbers coming in that started showing that, potentially the housing market was weakening. The second thing, and this is what we've really been experiencing over the last couple of months, is that manufacturing has slowed in the form of new orders. So the ISM index, which basically tracks how hot or cool the economy is from a manufacturing perspective, has precipitously dropped. And so that sort of takes us into the third phase and why it's, it's really anybody's guess here in the short term how things are going to price, solely because we don't know how much this is going to impact profits. We're about to enter into Q3 earnings season. It'll be very interesting to see how these companies, one, reports, but then also two, give us forward guidance on what the profits are going to be. And then the last thing to go as you're basically exiting the bear market cycle and then starting a new cycle is employment. And so we just had an unemployment print of 3.5%. Most of the time when we're coming out of a bear market, you'll see unemployment anywhere between 10 to call it 14, 15%. So the economy is still very, very tight. And most likely, again, we're probably sort of halfway through this bear market cycle. And one of the things I wanted to draw attention to is in the very top right of the chart there. So as you see in sort of that red, orangish area, the last thing to inflect out of all of this is core CPI. And so for those out there that think that the Fed will pivot in very short order, they're grossly mistaken because most of the time, from the very start of the Fed starting their cycle, or any central bank for that matter, for that to have a material impact on core CPI, you're normally looking at about 24 months. So again, just to summarize, I don't think we're out of the woods just yet on Fed rate hikes. Most likely they'll go neutral at the beginning of the year. We could see some additional hikes, but at this time they're going to continue to hike rates.
Thanks, Evan. And one question I think a lot of investors have is during our last quarterly update, you talked about predicting the markets and you thought that the markets would continue to fall. Have they reached the so-called bottom, or are we in store for some more down days?
Yeah, that's a great question. So the last time that we spoke, I basically highlighted that my year-end target for the S&P 500 would be somewhere between 33 to 3,400. Today we're trading right at 3,600, and I think that's still probably a fair range for us towards the end of the year here. But if you look at this chart, this is something I put together earlier. So between those two blue lines, this is what's called a bear wedge or a down channel that basically we've been stuck in all year. And so just looking at the chart alone, it's sort of telling you that here in the near term, we could reach 32, 3,300. Again, before we bounce off that, and I think, towards December, again, we'll probably be around that 33, 3,400. But what's keeping me up at night, and again, going back to that hope framework, is again, the earnings. And I think all of these Fed rate hikes, I think you'll probably see the ultimate market low somewhere within Q1 of 2023. I'm sort of, the way my models are showing me right now, that could be anywhere between 2,900 to 3,000. And then we sort of stabilize from there and hopefully towards the second half of 2023, start to have some sort of recovery. And so in conclusion, I think we probably have about another, call it 10 to 15% on the downside before this thing sort of starts stabilizing. And again, you can start taking advantage of it from there.
And I think, Evan, people that are listening today, they're probably wondering, this still sounds a lot like doom and gloom, and is it really a good time to put money to work? What does our portfolio look like? How do we take advantage of the way that the market is right now while putting our fees to work and creating those portfolios for the future?
Yeah, that's a great question. So despite it still sounding somewhat doom and gloom, again, we're sort of halfway through this cycle, in my opinion. So what I'll tell anybody right now, whether, they're looking to do a fee deferral or otherwise, is look, go ahead and get the account set up, get it funded and ready to go, because there are things that we can be doing right now. Because rates have risen so much, even a core fixed income, very conservative type portfolio is yielding anywhere between 5 to 5.5%. And then sort of my framework here on adding risk is, within that framework of the S&P 500, sort of take a bite at the apple at the 3,600 level, really start sort of backing up the truck at 3,300 and then buy everything at 3,000. And again, even though there may be some more doom and gloom on the near term horizon, I think if you take more of a longer term view, which these fee deferrals are, the normal horizon is 7 to 10 years, you're going to make a lot of money. My sort of forward long term projections right now are, even with a very generic 60-40 portfolio at these levels, you're looking at about 7 to 8% probably annualized over the next, call it 10 years. So again, rule of 72, if you take 72 divided by your investment returns, which we'll here assume 7, within that 10-year span, you could easily double your money, if not more, if we're doing our job correctly. But one other thing I'll say on the implementation is, no two portfolios are the same with our team. If you decide to do a fee deferral, we'll set up an initial conversation, really get a sense as to your risk and what your goals are with this. And again, we can do something extremely conservative that, guaranteed almost will make you 5 to 5.5%. And then on the other side of the spectrum, we've got some clients that are sort of swinging for the fences, and we're shooting for 12 to 15%. So in summary, everything is custom and bespoke. We'll work alongside you to make sure that you're comfortable with the portfolio, and that what we're putting together is in line with your long-term views. And again, given this entry point, I think it's going to be a very good ride.
And Evan, just before we close, I think there's people out there that'll always say, I'm gonna wait till we get closer to the bottom, or I'm gonna keep watching the market. What would you say to those investors who are sitting on the sidelines right now with their fee money in a qualified settlement fund, just waiting to invest?
Yeah, that's a great question. What I'll say is, look, nobody is perfect at timing the markets, myself included, which is why, I sort of have the framework that even right now within equities, it certainly makes sense to take a bite at the apple here at 3,600. So again, things could change. The Fed could pivot, inflation could come in quicker than we expect, and all of a sudden this thing starts turning around pretty quickly. And so I've seen it time and time again with the great financial crisis of 08, 09, when equities sold off back in December of 2018, and then with the COVID lockdowns in March of 2020 through April. Again, everybody would say, we think it's going to get worse. It gets worse. The market pulls back 20, 25%. And then before you know it, it's fully recovered and the opportunity is gone. So, I think having it in place, let's go ahead and have the conversation, really understands, the framework around risk and kind of how we want to invest. And again, just be ready to take advantage of it, because I think over the next couple of months, we'll reach that low, and ultimately it'll just be a great entry point.
Perfect. Thanks, Evan. And at Milestone, we partner with Evan and his team to execute these customized portfolios for our attorney clients. If you want to hear more about our program or how we work cohesively as a team to grow and secure those deferral funds, please reach out to me after this webinar. I can connect you with Evan and his team. And thank you for Evan for all the time and knowledge today. We look forward to hearing an update again in January, and hopefully we have some more positive news to reflect to everyone. And thank you for everyone who joined today.
Absolutely. Thanks so much, Amy.